What's going on, you guys? My name is Zach Hartley, and in this video we are going to talk about the relationship between risk and reward when it comes to your investments, as well as evaluating a variety of different investment options and putting them on the spectrum between safe and risky so that you can understand what your options are when choosing and evaluating your portfolio and what type of risk and returns you should expect based on your choices. Here is everything you need to know. Let's go. Okay, so the first thing we need to talk about is the relationship between risk and return, because it's super important. If somebody ever comes to you and says, hey, if you take part in this investment, you can get a very high return with a very low amount of risk or no risk, they are probably lying to you, because in almost every scenario and every long-term sustainable investment, the risk to return ratio looks exactly like this chart, where if it has a higher risk, it might have a higher return. So if somebody is promising you a return of 10 or 20 or 30%, that is really high and it's really good. It is probably going to come with some sort of risk or some level of risk above maybe one of the safer options that we're going to talk about in this video. So it's super important to just know and understand that in general, over the long term, everything resorts back to this chart, where if it has a higher return that somebody is trying to give you in terms of making more profit, giving you more cash flow, giving you better returns on your investment, it probably comes with higher risk. So that's the first thing you need to know. Second thing here is that inflation is something you need to account for and deal with when evaluating these decisions and making these decisions for your portfolio. Over the last 25 years, inflation has been about 2.5% on average. However, over the last few years, inflation got as high as 9.1%. It has been hovering around this 7 or 8% mark for the last few months. It looks like it is hopefully on its way down right now, but it can vary. It can get as high as 8 or 9%. In the 80s and 90s, I think it got as high as 14 or 15%. So inflation is something that is very concerning for us, because it basically represents the rate of increases in prices over time. So you've probably noticed in the last year or two, things have gotten more expensive. That is because of inflation. Now, just to give you a scenario, let's say that this year you go out and you buy $100 worth of groceries. If inflation is 8%, that means that next year, if you wanted to buy the exact same groceries, it's going to cost you $108, meaning that your same $1 just doesn't go as far. That's what inflation is, and ideally, you need your investments to make more money in that inflation in order to actually make you real money. Because if it doesn't beat inflation, let's say inflation was 2.5% and your investment yielded 1.5%, that means that you actually lost 1% in buying power year over year. And so realistically, in your actual life, you wouldn't have actually made any money because of inflation, unfortunately. Now, when it comes to investments, like we said, we want to make more than inflation, but if we want to make more and get a higher return, it's going to come with higher risk. So we're going to start out with our safe investments. Now, most of the investments on this list will basically yield you between 0 and 4% return. It kind of depends, and timing definitely plays a role in it. So I don't want to say what the guaranteed interest rates are for any of these right now, because it is going to change over time. But I will give you a breakdown. A T-bill is a bond from the government. Basically, a treasury bill is what it's known as. And this is generally and basically widely considered the safest investment that you can make, but it usually has a very small interest rate. Corporate bonds or municipal bonds usually have a higher interest rate, but they're dependent on the city or the municipality or the company that is paying back those bonds. Bonds are basically a form of debt that you collect interest on, and then you get the principal back at the end. Savings accounts can be very nice, because they can give you access to those funds while paying you an interest rate, usually between 2 and 5%, which can be very nice. There's also certificates of deposits, or GICs. These are basically guaranteed returns that the bank or the government is going to give you. And then you have cash. Cash is basically that 0% return. You're going to lose your money to inflation no matter what, but you're obviously not going to lose any money if you're just holding cash, as long as it doesn't light on fire or get lost or stolen. Now, those are all probably some of the safest investments that you're going to be able to find in the market. After that, you move to kind of the medium risk investments, where you're probably going to be able to generate somewhere between a 4 and 8% return. And this includes things like a broad market ETF, which is basically a basket of different stocks that trades like a single stock which is really nice because it gives you low expenses with instant diversification, and you can choose a broad market, you can choose a global market, you can choose whatever you'd like. You also have mutual funds. These do not trade like a stocks, and sometimes they have minimums. You can also hold gold or silver. You can also invest into real estate, or you can buy some large blue chip dividend stocks. These are usually considered the most reliable, steady, consistent, and safest of these individual stocks. Anything that's not like a massive company and doesn't pay a dividend is usually going to be considered a little bit more risky. Now, when it comes to the high risk investments, this is going to be anything that kind of tells you it's going to make a return of 8% or more. This is going to include things like individual stocks. It's definitely going to include things like options. These are just riskier versions of stocks. They're derivatives of stock prices. You also have crypto, or anything that has to do with crypto, including NFTs, is going to be very, very high risk. Anything to do with collectibles, being cars, being whiskey, being watches, being pretty much anything that you can collect, Pokemon cards, Yu-Gi-Oh cards, whatever it is, that is going to be considered a high risk investment. You also have commodities. So if you're trading in oil, if you're trading in wheat, if you're doing anything in the commodities market, very, very susceptible to market swings and fluctuations. And watches, I kind of mentioned this with collectibles. A lot of people are really getting into the watch investing game right now, and I think you need to understand that that is a high risk investment. As we've seen over the last 2 to 3 months, most of the watch market has tanked by about 20 to 30%. So it can happen. It does happen. You need to be very, very careful. And you need to have some type of strategic advantage in the market that you enter. So before you start diving into any of this, you need to make sure that you fully understand it and you have some type of advantage compared to everybody else. Now, how do you decide what to put in your portfolio? That's kind of the goal here, is to give you a bunch of different options so that you can decide what to put in your portfolio. And here's what I would consider if I were you. Number one, what are your goals? Are you looking for cash flow in the form of interest payments or dividends? Or are you looking for appreciation, where you're investing your money and hoping that it grows over the long term because you don't need to touch it? Those are two very different things. You need to keep that in mind, because setting that goal up front is kind of going to help you determine what actually fits into your portfolio to help you meet that goal. Second here is, how much risk do you want to take on? Depending on what your goal is, there's probably a variety of different ways to achieve it, depending on how much risk you want and how much kind of you are willing to take or burden with regards to monitoring and managing that account. So that is another thing that you need to kind of consider before you decide what you are actually going to look for in the marketplace. And then once you have figured out these two things, you need to identify what are the best opportunities that meet that investing criteria. That's the idea here. So identify, are you looking for cash flow or are you looking for appreciation? How much risk do you want in the strategy that is going to get you to that goal? And then what investments fit within that strategy? That's the process here, and that's how I would go about building your portfolio. Now, if you want to learn more about that and how the stock market works and how to actually buy and sell these stocks, definitely consider checking out my stock market course. It is completely free on Skillshare. You get 1 month free trial when you sign up with the link in the description down below. There is 10 hours of content. There's over 14,000 students that have gone through the course. There's over 400 reviews and 2 million minutes of watch time. So I promise you, it'll be the best course that you can find online, and it's completely free. It's not going to cost you a single penny. It is hosted on Skillshare. The link is down below, and I promise you, it'll be well worth the time. Thank you so much for watching this video. I will see you guys in the next one. Good luck trading, good luck investing, and we'll talk to you soon.